how do beginners not lose? How do they cover their downside? What are some simple things that you've seen that you can recommend to people just starting out? And then we can move on to the markets after that.
Well, I think one of the key things, part of the building of the intuition as a beginner is observing the markets and trying to understand those linkages. Another key thing to develop that understanding, frankly, is putting a little bit of money on the line, money that you're comfortable with possibly losing, in order to start to develop those intuitions. Because there's nothing better than putting money on the line, thinking, for instance, maybe you think bonds are going to sell off because oil prices just went up. Right. And you put that bet on in the markets, and you might be right or you might be wrong. And one of the beautiful things about putting some money on the line is that it quickly enforces fast learning. I mean, I can even to this day, 20 years in this business, remember painful market losses that I had back in 2005 when I first started trading markets, right? In the natural gas market. That still sticks with me today. And that's really how you accelerate your learning. Now, the important thing is just do it in a scale where it's used for learning, but not going to create an economic hardship if you get things wrong. Because as an early trader, I promise you're going to get lots of things wrong. That education is invaluable, but it shouldn't put you into uncertain economic circumstances while you're doing it.
Brilliant. And do you have a risk threshold that you would recommend for people? You and I were bouncing that beanbag back and forth on VAR and all these different things. Is there a total minimum loss that you think, hey, here's your floor, don't risk more than this? Any quick metrics that you can provide?
Yeah, I mean, it's interesting as a professional investor, you're constantly thinking about what's the max loss I can take and still continue to be able to manage money. And the reality is the same is true even for a small scale individual investor. Say you're investing $1,000 or $500 on Robinhood. It's the same exact circumstance. And so you might think, well, hey, if I want to do this over time to develop that intuition over the course of years, I need to be able to put myself in a position where I'm not losing so much money on any one trade, where I can't stick to it over the course of a couple of years. And so I think that's kind of the idea, like making sure that, even in a bad outcome, in a meaningfully bad outcome, you're not losing more than 25% of your money over the course of a year is kind of how, that's actually mostly what institutional investors target, at least prudent ones, I should say. And I think it's actually a good rule of thumb for the everyday investors that are getting on the field, investing and thinking about markets.